Austin Goolsbee said this morning there is still a flurry of economic data to be released between now and then. For more on where the Fed is headed and its impact on the economy, we want to welcome in Brian Levitt, Invesco Global Market Strategist, with his insight. Brian, thanks so much for joining us this afternoon. So talk to us about where you think, what your reading is on where the Fed is in its tightening cycle.
Well, the most important thing is we're either at or at near the end of the tightening cycle, which is incredibly important for investors and has been part of what's been driving these markets. Markets tend to do well in the aftermath of policy tightening cycles. From my perspective, I think the Federal Reserve should be done. You have inflation expectations in the bond market that are very well anchored. We're seeing even their preferred measure of inflation, the core personal consumption expenditure, coming down, the money supply is collapsing. So, I think that the Fed is done, but, at the very most, maybe one more rate hike to go.
Well, Brian, why do you think, I guess when it comes to core inflation, that being much stickier than those headline numbers, why don't you think the Fed needs to hike again then?
Well, the momentum, what's really keeping the core sticky has been really more of the shelter component. And if you look, there's a lag in how the Bureau of Labor Statistics calculates shelter. And so if you look at the S&P Case-Shiller Home Price Index, if you look at rents, the rent prices, they've already come down. So they're suggesting that the shelter component will be coming down as well. And also, if you think about the consumer, the consumer had lived under pretty draconian COVID rules for a while, had built up excess savings and came out and spent it on flights and used cars and Taylor Swift tickets. And the excess savings has started to come down, and that's likely to moderate as well, too. So, directionally, it seems clear where this is going. The core usually lags the headline by a bit, and the headline's already down to 3%. So I think the Fed is comforted, and they're particularly comforted by inflation expectations all being, around 2.5%.
And Brian, I want to ask you, in terms of where the Fed is in terms of fighting inflation and doing its job with regard to that, has it done enough, and are we indeed teeing up, from your perspective, for that soft landing that many talk about?
Well, we'll see. I think it's a little bit too early to be saying soft landing. Now, right now, the market has a soft landing trade to it. And we think that that's going to persist through this year, where the markets are excited or pleased by good GDP growth and inflation that's come down. The challenge that we have is that we've had 550 basis points of rate hikes in a little over a year. And as we're all taught, it takes a while. It takes a year to 18 months for policy to be felt throughout the economy. A year ago, the Fed funds rate was slightly above 2. 18 months ago, it was 0. So we still don't know the lagged effects of all of this, which is why I'd prefer to see the Federal Reserve back off, and which is why I think it's a little bit premature to be saying that we're not going to see an economic downturn. I think we may, but we're definitely going to see a slowdown. Whether we call it a recession or not remains to be seen. But what's most important is the market priced it in last year. The peak to trough declined 25% last year. That was the market pricing in what would be a mild recession.
So, Brian, then I guess, what does this tell us then about where we are in this market cycle, right? If we're not going to retest the lows, like you don't believe, maybe we did see the lows back in the fall of 2022, how should investors then be approaching the next several months, which it sounds like nearly from every single forecaster it's going to remain very uncertain, and that could last for quite some time?
Well, it's always uncertain, right? We're getting closer to policy clarity. And so that starts to create more certainty and less volatility in markets. So that's a good thing. We haven't seen policy clarity since the fall of 2021. So it would be nice to get there. Now, it depends how tactical investors want to be. If you're an investor looking out over the next couple of years, I would say take comfort in the fact that markets have almost always done well in the 2-3 years after inflation peaked and the Fed is done tightening. Okay, so a new market and business cycle will emerge when the Fed starts easing, and that'll probably happen in the middle of 2024. So between now and then, right now the market's got this nice recovery trade, and I think investors want to play it or should want to play it. It's a broadening out where the market is saying we've got good growth, inflation's coming down, we don't only have to bid up a small handful of names, it's broadening out to more names within the market value, cyclicals. Now, if you get the economic downturn at the beginning of 2024, you'll have one of those retracements. We're not going to go through the bottom. We'll give back some of what we've gained recently, but that's okay because there's your economic slowdown, or dare we even say recession, and that sets the stage on Fed easing. And so if you want to be tactical, it's going to be a recovery trade, potentially something of a contraction trade in early 2024. And then I would set the clock on the new cycle, and recoveries into expansions, which is what we're all hoping for. That tends to be a very good backdrop for risk assets.
But is that also still too bullish of an assessment? Because, we talk to some people who hone in on the inverted yield curve. Does it matter anymore in terms of it being a recession indicator and what happens in the market?
Well, I certainly think it matters. I mean, the Federal Reserve, the way an inverted yield curve happens, Federal Reserve raises interest. Let's see if I'm doing this with the right hand. The Federal Reserve raises interest rates, and nominal growth expectations come down. And so you get an inverted yield curve, which presages recessions. But we shouldn't conflate it from the macro call with the market call. Because again, if we remember, 13 months ago, in last September, the market was down 9% in a given month. That was the market saying we're going to have a weak economic outcome 12, 15, 18 months from now. And so I wouldn't say that the inverted yield curve doesn't have information. It does. It means the economy is likely to moderate, and the Fed's going to have to ease to normalize the yield curve. But the market, again, in my opinion, has already priced in a recession. I think what a lot of investors got wrong this time is markets typically bottom in a recession. But what also tends to happen in a recession is inflation peaks in the recession. So which one is it, right? There was this great debate. Do we have to bottom in a recession, or did markets bottom when inflation peaked? Just so happens inflation peaked probably 18 months before we're going to be contemplating a growth slowdown or a recession. So in my opinion, the market bottomed between June 2022 when inflation peaked and, when the market took off in October of 2022. So I don't, again, I'm pretty comfortable saying that the market has already priced it in. It's going to be mild given the lack of leverage and excess in this system. And Federal Reserve will pivot, setting the stage for a nice backdrop for investors.
Brian, earnings season has also been another real test here for the markets. Expectations across the board were essentially very low. We have seen a high number of companies come in better than expected. I'm curious, what's been the surprise to you from this earnings season? Because once again, a lot of the themes that we've seen play out over the last couple of quarters seems to remain intact when we're talking about the strength of the consumer, this excitement around AI, and the fact that the ad market, at least when it comes to tech, is still improving.
Yeah, and it's another one. I think what's surprising is the economy has held up as well as it has, which is supportive for corporate earnings. And you're seeing it. Yeah, it is in the larger growth names, but it's also broadened out to the more value-oriented names. You've seen good earnings beats from the companies that we would historically consider the value businesses. And so, that's what's giving an impetus behind investors moving beyond what has just become the somewhat overvalued mega cap names into the parts of the market that were trading at reasonable valuations or maybe even below historical levels. So, again, the surprise comes back to just the relative resiliency of this economy, despite all the policy tightening that we've seen and are yet left to feel.
And Brian, I want to ask you in terms of both what's ahead in this week ahead and the balance of this earnings season. You've got some big tech heavy hitters, whether we're talking about Apple and well-known names like Amazon. You also have Uber, Pfizer, JetBlue, et cetera. What are you expecting in the week ahead? Are we going to continue to see this pattern of just beating?
Yeah, I think we will. And a lot of that's what we already talked about, the resiliency of the economy and the relative strength of the consumer. I mean, remember, we still have a 3.6% unemployment rate. And so if you're an Apple, if you're an Amazon, if you're an Uber, you're supported by a consumer that's still feeling pretty good. And by the way, the S&P 500 peaked at 4,800. We're getting back up there. And I'm starting to hear from investors anecdotally and from financial advisors saying, you know what, I'm back at that high water mark, or I'm getting close to that high water mark. So people are feeling good. It doesn't persist forever. Again, I'm in the camp that this will moderate in the coming quarters. But for now, it's a consumer that continues to feel comfortable spending.
All right, Brian Levitt, we'll have to leave it there. Invesco Global Market Strategist. Thank you, Brian.